A commercial bank is a financial institution that accepts deposits from the public and gives loans for the purposes of consumption and investment to make a profit. It can also refer to a bank or a division of a larger bank that deals with wholesale banking to corporations or large or middle-sized businesses, to differentiate from retail banks and investment banks. Commercial banks include private sector banks and public sector banks. However, central banks function differently from commercial banks, despite a common misconception known as the bank analogy. Unlike commercial banks, central banks are not primarily focused on generating profits and cannot become insolvent in the same way as commercial banks in a fiat currency system. History. The name bank derives from the Italian word banco desk/bench, used during the Italian Renaissance era by Florentine bankers, who used to carry out their transactions on a desk covered by a green tablecloth. However, traces of banking activity can be found even in ancient times. In the United States, the term commercial bank was often used to distinguish it from an investment bank due to differences in bank regulation. After the Great Depression, through the Glass-Steagall Act, the U.S. Congress required that commercial banks only engage in banking activities, whereas investment banks were limited to capital market activities. This separation was mostly repealed in 1999 by the Graham-Leach-Bliley Act. Role. The general role of commercial banks is to provide financial services to the general public and business, ensuring economic and social stability and sustainable growth of the economy. In this respect, credit creation is the most significant function of commercial banks. While sanctioning a loan to a customer, they do not provide cash to the borrower. Instead, they open a deposit account from which the borrower can withdraw. In other words, while sanctioning a loan, they automatically create deposits. Primary functions. Commercial banks accept various types of deposits from the public, especially from its clients, including saving account deposits and fixed deposits. These deposits are returned whenever the customer demands it after a certain time period. Commercial banks provide loans and advances of various forms, such as overdraft facility, cash credit, bill discounting, money call, etc. They also give demand and term loans to all types of clients against proper security. They also act as trustees for wills of their customers, etc. The function of credit creation is generated on the basis of credit and payment intermediary. Commercial banks use the deposits they absorb to make loans. On the basis of check circulation and transfer settlement, the loans are converted into derivative deposits. To a certain extent, the derivative funds are increased by interval times the original deposits, which greatly improves the driving force of commercial banks to serve the economic development. Regulations. Main article, Bank Regulation. In most countries, commercial banks are heavily regulated, and this is typically done by a country's central bank. They will impose a number of conditions on the banks that they regulate, such as keeping bank reserves and to maintain minimum capital requirements. They also require some capital. Services by product. Commercial banks generally provide a number of services to its clients. These can be split into core banking services such as deposits, loans, and other services which are related to payment systems and other financial services. Core products and services. Accepting money on various types of deposit accounts. Lending money by overdraft, and loans both secured and unsecured. Providing transaction accounts. Cash management. Treasury management. Private equity financing. Issuing bank drafts and bank checks. Processing payments via telegraphic transfer, FPAS, internet banking, or other payment methods. Other functions. Along with core products and services, commercial banks perform several secondary functions. The secondary functions of commercial banks can be divided into agency functions and utility functions. Agency functions include: to collect and clear checks, dividends, and interest warrant. To make payments of rent, insurance premium. To deal in foreign exchange transactions. To purchase and sell securities. To act as the trustee, attorney, correspondent, and executor. To accept tax proceeds and tax returns. Utility functions include: to provide safe deposit boxes to customers. To provide money transfer facility. To issue travelers' checks. To act as referees. To accept various bills for payment, phone bills, gas bills, water bills. To provide various cards such as credit cards and debit cards. Commercial banking is a financial process that involves a commercial bank, which is an institution that accepts deposits from patrons and provides basic banking services, such as checking account services, savings, investments, and other money growth services, wealth management and financial guidance services, mortgage loans, vehicle loans, and other types of personal financing, credit card and line of credit services, ATM, automated teller machine, services. Commercial banks are often national chains with several locations across a given area. These banks are where most individuals and businesses manage their finances. For example, if you want to open a savings account, you might go to a commercial bank, as there's likely one in your general geographic area. Some businesses seek their initial business loans through commercial banks, and commercial banks typically service or provide home loans. How do commercial banks work? Commercial banks operate by providing financial services to individuals and businesses, under strict guidelines from the Office of the Superintendent of Financial Institutions, OSFI, which regulate activities like banking practices, financial and lending standards and practices, and general banking procedures in Canada. Commercial banks provide services within the scope of the OSFI and are subject to all federal and provincial banking regulations. How commercial banks make money. Banking fees and interest on loans or credit. Commercial banks make money in a variety of ways, but the primary income source for these kinds of banks is banking fees and interest on loans or credit. Commercial banks often charge fees for their services, which helps the bank earn money and continue to service their customers. For example, if a business owner opens a checking account for their small business, they might pay a monthly checking account fee to the bank. Banks also earn income from interest on loans and lines of credit. Interest is the cost of borrowing money, and banks can set their own rates for borrowers. When a business or individual borrows money from a commercial bank, there are many factors that affect their interest rate and eligibility, including credit history and performance, income, prime interest rates, loan amount, mortgage lending. Commercial banks are often the primary lenders for mortgage loans, providing different mortgage options for individuals buying a house. Mortgage loans are subject to prime interest rates, which are the rates set by the Bank of Canada. A lender can offer an interest rate that's either below or above prime rates, depending on the individual borrower. There are several factors that banks consider for mortgages, including loan term, loan amount, credit history, income verification, property value, current prime rates, employment type, credit cards and lines of credit. Commercial banks also offer lines of credit for businesses and individual credit cards. For example, if a person applies for an individual credit card, a commercial bank typically provides the funding for the credit limit. The bank earns money on the annual credit card fees for using the card, and on the interest the individual pays on purchases. The interest rates for credit cards are typically much higher than other kinds of funding, typically between 10% and up to 40%. Interest rates often depend on credit history and income. Bond services. Commercial banks also offer government bond services, acting as an intermediary between the government and its lenders. A government bond is an agreement between a government entity and a lender, typically a private citizen, to repay an amount of money plus interest within a specific time frame. A person purchases a bond through a bank, then when the bond matures, collects their funds plus interest. The government sets bond rates periodically, and they can change as economies change. Lockbox services. Commercial banks also often provide lockbox services, where clients can store money or other precious items inside a metal lockbox with a key. The bank provides storage and insurance for all stored items, providing a valuable service for a fee. Fees can vary based on the bank, the size of the box, and the cost to insure whatever is inside the lockboxes. Not all commercial banks offer lockbox services. Payment processing services. Many commercial banks also provide payment processing services for businesses. For example, if a grocer wants to accept credit cards at their store, they might contact their local commercial bank branch to set up a point-of-sale system with which the bank can process transactions. This service helps the business process credit card and checking transactions, often charging a fee for each credit card swipe. The bank can also help reduce the occurrence of fraud in payments by offering point-of-sale services to small or medium-sized businesses. Foreign exchange services. Commercial banks often provide foreign exchange services for foreign currencies. For example, if a visitor from the USA brings US dollars to Canada, they might need commercial banking services to exchange their USD for CAD. The banks monitor exchange rates and provide this information to the public, also exchanging physical currency inside individual bank branches. Commercial banks may also provide foreign payment services to international companies that accept various currencies for their products or services. While there are some similarities between commercial banking and investment banking, the two serve two very different purposes. A commercial bank provides funding to both businesses and individuals and provides mortgage, vehicle, and other kinds of personal loans. An investment bank offers financial services to larger corporate entities and institutional investors. Here are some key differences between these two kinds of banking. Primary services. A commercial bank's primary services include lines of credit, credit cards, small to medium-sized business loans, mortgage loans, vehicle loans, personal checking and savings, and ATM services. Investment banks provide larger funding amounts for corporate financing and investing. Regulations. While both commercial banks and investment banks are subject to regulation, they provide very different services, and fall under different kinds of regulation. For example, an investment bank may not even consider mortgage regulations because they don't provide mortgage loans, but might be subject to corporate lending regulations. Size and liquidity. While most commercial and investment banks have large amounts of liquidity to offer their clients for loans, funding, and other services, investment banks often need larger sums for aspects like corporate funding and investing. These banks are often larger, with more money available in various forms. Clientele. Commercial banks typically serve small to medium-sized businesses and individuals. An investment bank can serve large corporate entities, high net worth individuals, investment firms, and even governments. Economic role of commercial banks. Commercial banks serve an important role in an economy. As they provide basic banking services to the public, they provide a necessary component of modern life, allowing individuals and businesses to manage their money, borrow funds to grow or improve their standing, and offer financial guidance. They're typically a crucial component for homeowners, as they provide the majority of mortgage loans to the public. Homes are typically a large upfront expense, and mortgage loans help make owning a home more accessible by offering a longer loan term, typically between 15 and 30 years. Overall, commercial banks are critical to the economy because they provide necessary financial services, a way for citizens and companies to obtain funding for purchases and business actions, and help regulate financial markets and products. They make housing, large purchases, and lines of credit more accessible to the public and help with specialized tasks, like foreign currency exchanges. There are various types of financial institutions that make up a modern economy, including commercial banks. These institutions provide necessary economic services, such as checking and savings accounts and other monetary services, to both businesses and individuals. Understanding what a commercial bank is can help clarify the difference between a commercial and an investment bank and help professionals or business executives better understand the bank's role in the economy. Thank you for watching this video.